warm welcome to you, Nisha. And let me tell you, all the participants, Ritu, Ranjana, Yashoda, Tejita, Dipti, Arpita, whom all are here live. I'll tell you how this works. This is a coincidence that I'm the host again and Nisha is the speaker again. When AIWCAA started, one of the most hit session, you can see the full recording in our YouTube link. That is about the budget analysis. That was also taken by Nisha Sharma. She's from Amritsar, Punjab. She's into practice last more than 1 decade and was invited as a speaker with the Principal Commissioner of Income Tax there also to speak about union budget. Already taken a session here also. And Valuation Standard Board Manthan series was organized where she was moderator. And her passion, you will come to know how about it. She'll take it practically into income tax. So that's all, Nisha. Over to you. Let us all learn about the ITR changes, amendments, update, and please stay connected till the end. We will take up all your doubts, also all your queries, practically what are the glitches you are facing. So
yeah, thank you so much, ma'am, first of all, for such a great introduction. And secondly, I have been very blessed to be part of AIWCAA series again. And today, firstly, I would like to give a brief about today's session that I will be dividing today's session into 3 parts. First half, I will be discussing, I will be speaking, there will be one-way communication. We will be discussing about changes in ITR form. Second, there would be turn the table because there would be rapid fire round for all my participants who are going to participate, where I will be asking questions about the applicability of ITR forms on the basis of nature of income. Okay. So generally it happens that all the participants ask the questions, but today's session, it would be the speaker who will be asking you the questions. Okay. So thirdly, in third half, we will be taking up Q&A session in which I will be answering all the questions from the participants. So let me first share my screen with you all so that you will be having a better understanding by a visual presentation of the today's presentation. Okay. So let's start with great enthusiasm and positive vibes. Today's session is all about key changes by CBDT in income tax return form for assessment year 25-26. As we all know that in assessment year 25-26, there are various changes being introduced by CBDT in income tax returns for the sake of convenience, you can say, for the sake of transparency, for the sake of simplicity also. So basically, all these forms are designed in such a way that it will be extracting detailed information from all the assesses, whether it is in respect of their investment, whether it is in respect of their deductions, exemptions, incomes, etc. So these are detailed forms which have been introduced by CBDT. So form by form, we will be discussing the changes. Firstly, we will be starting with ITR 1. So ITR 1, as we all know that ITR 1 bracket Sahaj. So Sahaj is a Hindi word. Sahaj means comfortable. Comfortable means convenient. So basically ITR 1 is designed for the assesses in such a way that assesses would find it simplified form. So what are the various changes which have been made in ITR 1? If I will be giving you a brief description about what this form is used for. So firstly, ITR 1 is a form which has been used by resident individuals or HUF who have salary income, income from one house property only, or income from other sources, or agricultural income up to rupees 5,000. And the major thing which have to keep in mind is that income up to rupees 50 lakhs. So the assessees having income not more than 50 lakhs can opt for ITR 1. So what is the change? The change is that earlier, if the assessee is having a capital gain, long-term capital gain, they have to take up the ITR 2. But now the change has been made that taxpayers with long-term capital gain up to 1.25 lakh. So basically, if you are having long-term capital gain under section 112A and that long-term capital gain is up to 1.25 lakh, then you can file ITR 1. you need not to go to ITR 2 for under capital gain schedule. You can incorporate in ITR 1. So for your better understanding, I have taken this extract from ITR utility, ITR 1 form, where this type of window will be opening. This type of window will be showing ITR utility, in which they will be asking you uh, income on which no tax is payable, long-term capital gain under section 112A not chargeable to income tax. So as you can see on your screen, there are three informations which they will be asking. First is total sale consideration, where you will be putting up the figures regarding the sale consideration, which on which you have at which you have sold the long-term capital assets chargeable under section 112A. Total cost of acquisition, we will be putting up cost of acquiring those assets which are covered under 112A. And for your reminder, I would be giving you a brief summary that 112A covers only three assets: equity-oriented mutual funds, units of business trust, and listed shares. So basically, when you are transferring these securities on which STT is paid, then 112A long-term capital gain would be there, and we will be reporting that long-term capital gain under this window. But the thing is that only up to 1.25 lakhs. That is up to exemption limit. If you are earning long-term capital gain under 112A, but that is crossing 1.25 lakh limit, then you have to go to ITR 2 again. It is only covering the exemption limit window. Okay. And same change has been made in ITR 4 Sugam form also, where this type of window will be there, in which you can report your long-term capital gain under section 112A. So the basic change is that you need not to go to ITR 2 for your capital gain schedule. You can itself incorporate your long-term capital gain in ITR 1 and ITR 4 based on your other incomes. Second amendment is, it is the major. You can say that it is the major amendment which have been made by the Finance Budget 2024 itself. And now it is being practically implemented in ITR forms also. What is that? Capital gain reporting. As we all know that after Finance Budget 2024, there is a cut-off date, that is 23rd July 2024. Because this is the date on which Finance Budget was introduced. So basically, 23rd July 2024 is the cut-off date. Why? Before that date, tax rate are something different for capital gains. Either it is short-term capital gain or it is long-term capital gain. And after 23rd July 2024, rate of capital gain, taxation rate of capital gain are completely different based on the nature of assets, whether it is long-term capital gain or short-term capital gain. So 23rd July 2024 is the split by date of transaction. Means now whenever you will be opening your ITR 3 or ITR which is applicable on you based on your nature of income, there they will be demanding information by date, by the split of date. So basically, I have again taken this extract for all of you to make you better understand that what is that split of date. So whenever you will be going in long-term capital gain here, short-term capital gain is there and long-term capital gain is there. First point is from sale of land or building or both. And you can see that it is before 23rd July 2024 and on or after 23rd July 2024. So while putting up your information regarding the capital gain, you have to make bifurcation between the dates. 23rd July से पहले अगर you have sold या transferred the capital assets, and if the assessee has sold capital assets after 23rd July 2024, you have to make the bifurcation in the ITR form itself based on the information which is available with you all. And there is a major amendment also regarding the unlisted bonds or unlisted debentures. So basically, if coming to this point again, most of the assessees are not aware about the amendment. We all know that indexation benefit has been removed. It has been taken aback by the government for all the assets if those assets have been transferred after 23rd July 2024. But most of the time, whenever I am taking any kind of webinar or seminar, I have come up with questions majorly. There is an amendment which I want to share with you all, that if resident individual is transferring any immovable property, being land or building, after 23rd July 2024, indexation benefit is still available for that resident individual. It is only and only for resident individuals. If you are selling your immovable property after 23rd July 2024, indexation benefit is still available for you. But there are two options. Then either you can go for 12.5% without indexation, and you can go for 20% with indexation. It is up to you which option is beneficial for the assessee. So basically, indexation benefit has been removed for all other assets except immovable property. That has to be kept in mind while filing the returns of the assessee. Second major amendment is regarding sale of unlisted bonds and debentures. So what is that? The thing is that if any of the assessee is selling unlisted bonds or debentures after 23rd July 2024, then it would be always short-term capital gain irrespective of period of holding. So basically, this is the major amendment, that if any of the assessee is transferring unlisted bonds or debentures other than capital indexed bonds or sovereign gold bonds, because they are exempted, then if they are sold or transferred after 23rd July 2024, they will always be shown under short-term capital gain, irrespective of period of holding. So basically, this was all about long-term capital gain and short-term capital gain. And as you can see that this reflect Finance Act 2024 changes. LTCG tax on real estate reduced from 20% with indexation to 12.5% without indexation for pre-July 23 purchases. And this next, if we will be moving toward another amendment made in ITR form, and that is about asset and liability disclosure. So in order to understand the change, first we have to understand the original provisions prevailing nowadays. If any of the assessee, being a resident individual and HUF, is having a income up to rupees 50 lakh, but means not more than 50 lakh, then there is a requirement regarding asset and liability disclosure, that assessee, he or she, have to give the detailed information about the assets and liabilities held up to 31st March 2025. So basically, that threshold limit is now being increased. Now, what is the amendment? That if any of the assessee is having total income exceeding 1 crores, then he will be liable to give the asset and liability disclosure requirement in the ITR 1 or ITR 2. So basically, earlier the limit was 50 lakh. Now this limit has been enhanced to 1 crores. So up to 1 crores of income, you need not to give asset and liability disclosure in your ITR form. So this will be reducing the compliance burden over the assessees. So this is a welcoming move by CBDT, that limit has been increased. Okay, so this will be reducing the compliance burden. Now there is a amendment in 80C to 80U deductions. As we all know that from the last few years, assessment notices, scrutiny notices have been sent by department to various salaried individuals or another assessees who are claiming deductions for LICs, for their interest on loan, and for higher education's interest loan. So basically now a strict action has been taken by CBDT in this respect to avoid undue claim of deductions. So basically, if any of the assessee now from assessment year 25-26 onward want to claim any type of deduction, whether it is ATC, whether it is ATGG of you can say that rent paid by the salaried individuals, or whether it is ATD, or whether it is ATDD, or whether it is ATU. you have to give the detailed information asked by the department in these forms. So I will also be giving you this presentation in this video, like that ATC. In case of ATC, you need to give the document or receipt number or policy number of the policies in case of life insurance, national saving certificates, PPF. In case of ATD, you have to disclose insurer name and policy document number. So CBDT is making it sure that nobody is going to claim any of the false claims, any of the false deductions in ITR forms. ATE, ATEE, EEA, AEB, this all about electronic vehicles. And if you have taken up your loan for purchasing your house or electronic vehicles or higher education, all these sections covering those provisions. So now you have to disclose lender name, actually, loan account number, sanctioning date, and outstanding amount of loan as on 31st March 2025. So CBDT is not, you can say that it is not giving you the opportunity that any of the assessee could easily give only the amount of the deductions and claiming it in ITR forms. You have to give the detailed information about all the deductions you are claiming, and these all are mandatory fields. When you will be filing your ITR form, these all are mandatory field with asterisk mark on that. So basically, if you will be skipping those fields, ITR form will not be proceeding further. It will not allow you to file your income tax return. So basically, again, I have taken the extract for the better understanding, because with visual presentation, it would be highly understandable. So what is that? ATDD, if we will be talking about ATDD. So basically, it will be asking you about nature of disability. What kind of disability is, with which kind of disability suffering on dependent or on assessee. If it is about the assessee himself, type of disability, reduction, if you are claiming deduction under section 80DD for the dependent one, so PAN of dependent, Aadhaar of dependent, acknowledgement number of form 10IA filed, and UDID number if available. So basically, nature of disability is the mandatory field, but PAN, Aadhaar, acknowledgement number, all these are not mandatory. And if you will be skipping all these fields in case of 80DD only, it will be allow you to proceed further. Again, if you are claiming deduction under section 24B, we all know that section 24B is all about if you have taken a loan for purchase or construction of your house property and you are paying interest on that loan, you can claim that deduction in case of deemed let out property or let out property under only new regime. This deduction is available in a new regime for let out properties only. For self-occupied property, if you are opting new regime, then it will not allow you to claim this deduction. So this is another point. This is a, you can say that plus point in other than this today's topic. So first it would be asking you loan taken from. Loan taken from here with the drag drop option, you will be selecting banks, public financial institutions, etc. In options are available. Name of bank institution, person from which loan is taken, loan account number. It will be asking you about the loan account number also in order to check the authentication and to verify whether actually this loan number, loan account number is existing. Date of sanction of loan on which this loan is sanctioned by the prescribed authority. Total amount of loan, loan outstanding as on last date of financial year, and interest on borrowed capital. As you can see, all these are mandatory fields. All these are mandatory fields. So if any of the assessee is going to claim deduction under section 24B, they have to fill all these columns. Only then he or she will be allowed to claim these deductions in their ITR form. Otherwise, section 24B deduction would not be allowed. So basically, CBDT has made these steps so that to avoid and to curb the loophole earlier that was prevailing. that any of the assessee could claim the deduction without producing any relevant evidences over there. So basically now, without the production of any evidences, without giving the detail, because it is not a ITR. When you file your ITR, it is not an annexure. It is annexure less actually form. You need not to attach any of the evidences along with, but you have to provide your detail in the ITR form itself. So basically, this was all about the deductions. It is only some of the extract which I have taken from ITR utility in order to give you the better understanding of the deductions, but there are various other deductions, and all these deductions require all these formalities to be completed before claiming those deductions. Okay. So next we will be moving to new tax regime opt-out disclosure and form 10IA. So basically, most of the assessees have this confusion in their mind about opting in and opting out of the regime. Most of the assessees having this confusion, this doubt in their mind. So let me first clear the background. From assessment year 24-25, new tax regime has been made a default tax regime for all the assessees. Default tax regime, we all know the vocabulary meaning. Default means it is applicable on all the assessees if corresponding, if retrospective, if reciprocate action has not been taken by the assessee. So basically, if I am not opting out of new tax regime, it would automatically be applicable on me. So what this requirement is saying to us, this requirement is all about whenever you will be filing your ITR return, that ITR form, whether it is ITR 2, whether it is ITR 3, ITR 4, ITR 5, they will be asking you about the opting in or opting out of new tax regime. That otherwise, this new tax regime is applicable on all the assessees. But if you want to opt out of new tax regime, you have to give the declaration. For salaried individuals, or you can say that for individuals or for assessees who are not having business incomes, they need not to file any specific form in respect of opting out of new tax regime. Okay. But for business personals, those assessees who are having business income, who are having professional incomes, they need to file a specific separate form, that is form 10IA, if they want to opt out of new tax regime. Okay. So basically, for assessees, we can categorize assessee into two parts for this purpose. Those assessees which are not having any business income, they can opt out of new tax regime at the time of filing ITR forms. Okay. But those assessees who are having business incomes, they need to file a separate form 10IA EA before filing of ITR. Okay. And here I have also given you the extract also, that what kind of information it would be asking you in case of ITR 2, because ITR 2 is filed by those assessors who are not having any business income. So it would be asking you only under which section you are filing your income tax return. If you are filing by due date, it would be 139(1). And do you wish to exercise the option under section 115 BAC 6 of opting out of new tax regime? 115 BAC 6 deals with opting out of new tax regime. So if you want to opt out, you have to give declaration over here only. You need not to file any form 10 IEA in this respect. So if you will be opting out, you will be selecting this option. And if you will not be opting out, you will be selecting no option. Okay. So this is only for those assessees who are not having business income. But those assessees who are having business income, as I have written over here, if assessee is having business income, okay. So those assessees who are not having business income, previous slide was applicable, those are having business income. Yahan par explained information is required. What is that? Method of opting out of new tax regime for current assessment year. And what is that method? Assessee has to file form 10IA before filing income tax return. Okay. And have you exercised this option under section 115 BAC of opting out of new tax regime in assessment year 24-25? If you will be selecting yes, okay, there is an option yes. If you are selecting yes, then this will be activated. these columns would be activated, and they are asking you about date of filing of Form 10IA. What was the date when you have filed the form? Acknowledgement number of Form 10IEA, and date of filing of Form 10IEA for assessment year 25-26 as well. So basically, this requirement is only for the assessees who are having business income. This detailed requirement is only needed for the assessees having business income. But those assessees who are without any business income, that salaried individuals, etc., they can shift between new tax regime, old tax regime year by year. They don't have any restrictions over there. They can shift between these two regimes year by year. But the assessees having business income, they can only opt out of new tax regime once in a lifetime. For example, if I have opted out of new tax regime in assessment year 25-26, then in the next year, old tax regime would be applicable on me for the subsequent year itself. Then I don't have any option to shift back or come back in new tax regime. So basically, these are various amendments which have created chaos or confusions about the applicability of Form 10 IEA, etc., etc. So this I have made you clear. Next, when we are talking about ITR 3 and ITR 5, okay, we all know that ITR 3 form is used when there is a business income, okay, and ITR 5 is used by partnership firms and LLPs, okay. So basically, ITR 3 and ITR 5, all those requirements which we have discussed earlier, they will be applicable on ITR 3 and ITR 5 based on the conditions prevailing at that time. But there are additional requirements also whenever you will be entering into your e-filing portal, and you will be opening your e-filing portal, and you will start filing your ITR. This type of window will be appearing on the screen. And what this window asks you about, that if you are the assessee who is not liable to file your income tax return under section 139 subsection 1 because you don't have any taxable income, okay, then also if all these requirements or any one of these requirement is there, you are required to file your income tax return. You can't skip your income tax return on the basis that no, I don't have any taxable income, I am not earning any kind of income, so I do not want to file my income tax return. No, this previous slide is about filing return of income due to fulfilling any one or more below mentioned condition as per 7th provision to section 139 subsection 1, which says that if any of the assessee has deposited amount exceeding 1 crore in one or more current accounts during the previous year, then the assessee would be liable to file income tax return. If assessee has incurred any expenditure exceeding 2 lakh for a foreign tour, then also he or she will be liable to file his or her income tax return. If any of the assessee has incurred expenditure on electricity expenses exceeding 1 lakh, then also he or she would be liable to file income tax return. Are you required to file a return as per other conditions prescribed under clause 4 of 7th provision to section 139 subsection 1? So basically my point is that if any of the person is having taxable income but beyond the basic exemption but not beyond the basic exemption limit, but any of the point is prevailing in his case, then he or she would be liable to file its income tax return. These points were earlier there. This cannot be said an amendment. This was earlier there. Earlier, this point was also we were considering, but as we are discussing about the changes, so it was a high time to highlight all these points as well, so that if any of the assessee has any confusion about that whether he is required to file his income tax return or not, he can clear that confusion. Okay. So basically for corporate and trust filers, ITR 6 and ITR 7, we all know that ITR 6 is for the companies and ITR 7 is for the trust, college, institutions who are covered under section 139, subsection 4A, 4B, 4C, 4D, section 8 companies. They are also required to file ITR 7. So basically, in those cases, the amendments which we have discussed earlier, all these amendments which will be prevailing, first is capital gain split. As I have discussed earlier, and for those participants who have joined now, I want to give you a brief about that because this is the major amendment which we all need to know. While filing your income tax return, you have to keep in handy the detail about the capital assets sold before 23rd July 2024 and after 23rd July 2024. Why? Because it would be having impact on your tax liability. It is going to decide about the taxation rate, because as I have already explained at the beginning, that before 23rd July, rates are different, provisions are different. After 23rd July, rates are different, provisions are different. Okay. So basically, whenever you are going to file return of any of the client, you need to keep all the documents handy about the capital asset, nature of capital asset first, then period of holding, and third one is uh, uh, taxation rate. Okay. And next amendment is buyback losses allowed. Now, this is one of the most important amendment which have been taken place after 1st October 2024 actually. Now, from 1st October 2024, whenever the assessee is getting any amount in respect of buyback of shares, any of the domestic companies paying buyback amount to the assessee, it is taxable in the hand of shareholder themselves. Unke haathon mein that amount is taxable. Okay. So basically that buyback amount is fully taxable under the head income from other sources. And now the question arises that what about the cost of acquisition which we have paid at the time of acquiring that security? So CBDT has made an amendment that you can claim that cost of acquisition as a capital loss. Okay. So basically two head would be involved. First is income from other sources. You have to make a declaration about the buyback amount you have received in income from other sources. That would be taxable under the head income from other sources, complete amount. And if you have paid any cost of acquisition to acquire those shares or securities which have been bought back by the company, then that cost would be claimed as capital loss under the head capital gain. Okay. So again, new business disclosure, new section has been introduced, 44 BBC. This section is all about non-resident engaged in cruise ship business. So basically, this is a presumptive taxation section which have been added in another presumptive taxation section, in which 20% of the gross receipt would be shown as a profit for the non-resident operators who are engaged in cruise business. Okay. So basically, this is the disclosure requirement, and the foremost important disclosure requirement is enhanced TDS reporting. This reporting is all about now if any of the assessee is claiming TDS in his or her income tax return, they need to give section-wise explanation. Earlier, there was a leniency, there was a privilege for all the assessees that if you are not sure about the sections, need not to mention the section itself. But now onward from assessment year 25-26, you need to mention TDS credit if you are taking in your income tax return section wise. Okay, so this is enhanced reporting requirement. So again, for your better understanding, I have this on your screen. Buyback losses would be reporting like this only. Dividend gross means any dividend, any kind of dividend if you are taking, it would be shown under income from other sources had. But here is the amendment. Dividend income under section 2 subsection 22 clause F. This is the section which have been added, which have been introduced by CBDT for declaring your buyback amount as a dividend, because it would be considered now as dividend under section 222F. Okay. So this is the requirement which you have to fulfill while filing your income tax return. So as we are proceeding towards the end of the session, so I would be taking these small sections into consideration. First is Aadhaar ID removal. Earlier, there was a provision while filing ITRs, assessees were allowed to file their income tax return if they have applied for Aadhaar number, but they have not been allotted the Aadhaar number yet. So they were allowed to file their income tax return. But this is the major provision now, because as you have not been allotted Aadhaar ID, you have not your Aadhaar number, it would be difficult for the assessors to file their income tax return. So this is the another amendment which have been made by CBDT in the income tax return forms. Next is we are talking about compliance updates, because today's webinar is all about changes in ITR form and compliance update. So we already know that due date for filing income tax return has been extended to 15th September 2025. But if any of the assessee is not able to file income tax return till this date, he or she has the opportunity to file belated return, and that return could be filed up to 31st December 2025. And if you have filed your original return, but there are some changes you want to make in respect of your incomes or any modifications, you can file revised return, and that is also up to 31st December 2025. So last chance to file your income tax return is till 31st December. There is another privilege of filing ITRU, which we will be taking up in another session, and there is a that ITRU session is in our pipeline. Next is its pending verification. Earlier, there were limited options available that if you want to file your income tax return and after that you want to e-verify your returns, you can only take the Aadhaar OTP net banking. But nowadays, Demat account linking is also there. So it would be for the better convenience of the assessees that they could verify their return. If they are not able by Aadhaar OTP or net banking, they will go with the Demat account verification also. So, okay, with this conclusion, you can say that while filing your return, you can take these points into consideration that you have to check the eligibility, because this point I want to mention that selecting the ITR form is the crucial point, because if you are selecting a wrong ITR form, it would result into invalid return or defective return for you all. So while selecting your ITR form, you must have a clarity about the concept about the nature of income. Detailed disclosure is required, as we have discussed in the webinar. Choose tax regime wisely. So basically, before choosing your tax regime, you have to make a comparative tax liability statement that in which it is beneficial for the assessee, not for the current previous year, but for the coming years also, that if you are opting out of new tax regime, you will not be able to come back into new tax regime in the subsequent year. And you have to be very careful about choosing your tax regime, because it would not be helping you out in the futures. Okay. File timely, 15 September is the last date. You need not to wait till the last date, because portal in the last dates become very slow. So basically, you have to file your income tax return timely and stay informed about all the updations, about all the changes in the provisions. And as I have told you in the beginning of the session that there would be a rapid fire round. But first of all, I would like Dipti ma'am to be intervene in between so that I could shuffle to rapid fire round. So be prepared for that. Over to you, Dipti.
Thank you. Thank you so much, Nisha. We can close the PPT so that we can come on screen.
Okay, so my question to all the participants is that if any of the assessee is having a salary plus non-presumptive income, so quickly you have to give the option in the chat box. You have to comment in the chat box, and Deepti ma'am would be reviewing that if any of the assessee is having salary plus non-presumptive business income, so which ITR form he or she would be filing. Quickly.
ITR 3 is the answer. Quick answer. The first one to answer is Venkatesh.
Okay. ITR 3 is the answer. So basically, okay. So next question is that suppose if there is a loss which assessee wants to carry forward. Okay. Loss could be from capital gain, business loss, or house property. So would he or she will be allowed to file ITR 1? Yes or no?
No. No.
Okay, so
Yes.
answer is no. So basically, if ITR 1 could be filed only by those assessees who do not have carry forward or brought forward loss. So with this, we are making our provisions revised. Okay. So next is, okay. So if any person is having a salary remuneration interest received as a partner from partnership firm, so what ITR form would be applicable on that assessee? Quickly. Deepti ma'am?
ITR 3, and oh my God, there's a competition between Venkatesh and Sirisha for quick answer. I think they are on the keyboard itself.
Okay,
Great,
so
great, great.
I would like to give huge round of applause to all the participants who are participating. So basically, if you are a partner in a partnership firm and you are getting salary remuneration interest, you will be filing ITR 3,
Great.
because the reason is that section 28 subsection 5 says that any interest, salary, bonus, commission, remuneration received as a partner from partnership firm is a income from business or profession. Okay. So now, last question of rapid fire round is that if you
Get up, get up. Let
if
them be
you have
ready.
salary and more than one house property, okay, if you have salary and income from more than one house property, so would you be allowed to file ITR 1? Hurry up. Would you be allowed to file ITR 1?
No, it's ITR 2.
Yes. So basically, it would be ITR 2 because ITR 1 is allowed if the assessee is having salary income and only one house property is there. If you have income from more than one house property, then you will be shifting to ITR 2. Okay. So with this, we will be finishing up our rapid fire round, and Dipti ma'am will be announcing the winner after that. And now I am very much eager to have the questions from the participant. Kindly ask your questions.
Yeah, please.
Okay.
Yes.
And in case we have, ma'am, salary and presumptive income, both the incomes, which ITR will be filed?
Ma'am, if you have salary plus presumptive income, then ITR 4 would be there, because ITR
ITR
4
4.
is for the presumptive income, and for salary income there is ITR 1. But if both are there, then ITR 4 would be applicable.
Nisha, I am like overwhelmed to see your PPT, how much effort you have made, not only in covering up all the ITR changes, but also the amendments and linking it up. Superb, awesome work, right?